as long as those rates remain as low as they are, it's undoubtedly going to lead to that. And I think the issue is wider than just bonds as well. I mean, I think most investors, the asset allocators, are struggling to identify the right kind of investments to make. I mean, equities at the moment are extremely volatile. Bonds are at levels of yields that we've never seen before to some extent. So investors really, have a limited choice of asset class to look at. And I think that plays very favorably for real estate, notwithstanding that yields are obviously in absolute terms quite low. And I think, unless and until there is some growth or indeed inflation that comes back into the European economy, it's hard to see how those rates will shift. And so I think we share the view that they'll stay relatively low, and that, I think investors are creeping up the risk curve, to come back to Pertti's point, and so looking outside of core into the core plus. Whether they know what they're doing is going to be the difference as to whether we're back in 2006 or we're in 2016. That's the key point. Do they really know what they're investing in and what sort of price are they going in at? And I think the last point is, as maybe you were going to mention, is also the leverage position is very different, as we were saying before.
Okay, Pertti, you wanted to pick that up?
Yeah, just a couple of points to add. I think that just mentioned here that two things. What are the different things from 2006 and 7? AFMD, that was not in place at that time, so that's kind of keeping some of the players out from the riskier players out from the property business. Another one is that there's way much less debt this time. It's not only because of the solvency and Basel requirements, but also AFMD regulations and all that. Seems to be that it's a more equity game this time. And so forth. Going back to the pricing a little bit, we look always the fundamental values. So, when you're looking for the fundamental values in CBD of London or so, it's very, very expensive in the long term. Whether the interest rates will remain that low or not, but the fundamental values are so important for us that's why we feel like it's very expensive out there.
Okay, good.
And if I could just add a point about the comparison to today, to 2006 and 7, I think the other key difference is the breadth and depth of equity that is out there. Because in 2006-7, it was concentrated in a relatively small number of hands, and now you've got a much broader base. People like Norge weren't investing in 2006-7 into direct real estate. They're a big player. The Chinese were not a significant player in 2006 and 7. Now they are. So you've got a much broader base of capital. So I think that's just, as we said, the start of that trend. So I think we're in a much better place in terms of the overall stability with the leverage and the broader base of capital.